Welcome to the daily update, where I'll go over the action in the market for Friday, June 20th, and we'll see how things look for Monday, June 23rd. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. It's kind of a strange week in that the market was closed on Thursday, so we worked off of Wednesday's close for Friday. Now we're somewhat back to normal, but it's always kind of throws things out of whack a little bit when we have a 4-day trading week instead of the usual 5-day trading week. So we ended up closing down. We are seeing some weakness creeping into the market. Now, some of that is because we have not been trending, and a lot of the momentum oscillators, the way they're calculated, they can't help but start to drift lower. But that can end up being a self-fulfilling prophecy. You see something going down, and it's like, oh no, we're turning more negative. Now, a good solid update could take care of that. But as I said, we're still not trending. Now, so far, the 20-period moving average is holding up. The short-term trend, seeing a little bit of vulnerability, but still intact. So we're still positive in the short, intermediate, and long term. Okay, so right at the open, we had a gap higher open. Looks like we were able to at least get a good start going there. I was watching the futures as I could over the close day, and we were down like 0.86% or something there for a while. But then the futures were able to come back. The market wasn't open on Thursday, so whatever reaction was taking place in the futures, the cash market didn't get a chance to do anything about that. And by the time we opened on Friday, things had switched back and we're looking more positive. So we opened up above R1 at 6,009. So we were, at least at the start, above the 6,000 level. Then we declined down below the daily pivot at 59.90. We got down below the unchanged level, so then we went negative, but we found support at 59.62, and we were able to rise back up to the unchanged level, which, as I said, these pivot points on a 10-minute intraday chart, which I update on the YouTube community tab every day, those are pretty important levels, and I watch them while the market is open. But the unchanged level is either a support or resistance level as well. We were able to go back and turn a little bit more positive. Now, it was, you could call it either triple or quadruple witching on Friday. It's the last options expiration for the quarter, and that produces a big surge in volume and a lot of volatility that may not otherwise happen. So the pivot points, we didn't quite stick with them. They're shooting more for actual round numbers because those are strike prices for options. Okay, then we dropped back down. We went negative below the unchanged level. We dropped below S1, tried to rebound a little bit later on as we fell back below S1, but then we were able to close just a little bit above S1. By the time we closed, we were down 0.22%, massive increase in volume, triple witching, quadruple witching, whatever you want to call it. You have a lot of these things taking place in Friday's session. So we are still positive in the short, intermediate, and long term. We're not trending, and we're seeing some weakness coming in. We're still under the 4.5% level with the 10-year yield. That's good. And we're seeing some kind of weak economic reports that have been coming out in the past week, and that's causing some concern about the overall health of the economy. We're going to get a lot of additional economic reports coming out in the upcoming week that we'll see. Is that scenario going to continue to unfold, that the economy showing some weakness, or are we going to show some strength coming back in? And of course, the big geopolitical event is Israel-Iran right now, and then what level, if any, U.S. involvement is going to happen. All right, so some comments. President Trump did come out and said that he will decide on a final course of action that with Iran over the next 2 weeks. And of course, you know, he has multiple things, and he's going to look for a lot of input from Israel and possibly NATO and, you know, different allies and things that you need to put together with all of this. It's But it's a tough decision to make. And folks are really divided on, yeah, we should go in and help Israel because ultimately Iran looks at Israel as the enemy. They also look at the U.S. as the enemy. And if we had been able to prevent the Nazis during World War II, instead of just sitting back, because after they invaded Poland, Britain and France declared war on Germany, but didn't do anything about it. There were little skiffles here and there, but that just told the Nazis they could do whatever they wanted to do. Some folks think that's the approach that President Trump should take. It's like, okay, we need to do what we can with Iran because ultimately they're coming for the U.S. And those interballistic or intercontinental, the big missiles, they don't need those to fire at Israel. They need those to fire at the U.S. and Canada. And so that's one side of the equation. The other side is, well, look at Vietnam, look at Afghanistan, Iraq, going in and nation building, regime change, and then we go in there and then we impose our kind of government on people that don't want that kind of government. It's just like, let's just lead them to what they want to do, and then but then that leaves other variables out there. Okay, so if there is a regime change in Iran, what's going to come after that? You know, the son of the former Shah that was the leader before the 1979 revolution, he's been coming out and making some statements. Is that what people want? You know, it's a really complicated issue. Okay, and then European ministers for foreign affairs, and they're trying to talk with their counterpart in Iran. They didn't come to any breakthrough. They're not really getting anywhere with Iran right now, just like the U.S. is not really getting anywhere, and Israel's not getting anywhere with Iran. But they're still gonna agree to talk more. So that's seen as somewhat positive. Then on the Fed front, we had the Federal Open Mouth Committee, which came out on Friday. Governor Waller said that he doesn't think that there will be tariff inflation and that the Fed could cut rates as early as July. Okay. Then you had, additionally here, Mr. Waller was careful to indicate that this was only his view and that he isn't speaking for the Fed. Well, then why say anything? It's like, okay, I've got how I feel personally. Shouldn't he take that into the meetings? I mean, that's kind of his job. At least that's where I come out on this. But yeah. Then Richmond Fed President Barkin, who's not a voter right now, came out later in the day and says he sees no rush to cut. Man, you got to imagine what those meetings are like, because everyone thinks they're right and they're economists, so nobody's right. And you have economists, you know, one side argues one thing and other side argues another thing, and they come up with like four conclusions, you know, based on two sides. He says because there's tariff uncertainty, we don't know how this is going to go out. And this was weird, worded kind of crazy here. Resilient economy. Well, right now we've been seeing things getting a little bit weaker. Is that hopefully going to bounce back? Now the employment area is holding up for the time being, and so that could be part of the resilience that he's talking about there. But in Friday's session, mega caps and semis didn't really have a good day that way, because now switching to another area, the Trump administration is planning to revoke waivers that allow chip companies to use American chip making technology in China. It's like, okay, do we really want to be sending this real high-end, very high-tech technology over to China, who we're not exactly friendly with them, and that could impact some of the semiconductor companies, because right now they do have a waiver, and the Trump administration is going to make those waivers go away, possibly here. So oil was up. It was kind of another strange day there because the markets were closed on Thursday, but oil still kept trading during that time. It's up over 74 now. It actually declined on Friday, but it had gone up while the markets were closed. And the VIX is still above 20 at 20.62. Stochastics now, we're still getting extreme positive readings with some of these indicators, but they're all turning negative. Like the stochastics, they're starting to drop down below their moving averages, but they're still extreme positive. And the slope oscillator's back to turning back down. It's still extreme positive and dropping below its moving average. Intermediate term, we still have that rate of change going back 50 periods, because that's calculating the low set in April. And that just shows a massive move up, which is what we actually ended up doing. So it's giving us an extreme positive reading. And then our momentum oscillators, like the PMO, it's still extreme positive, but now it's actually negative, dropping below its moving average, as are a lot of the momentum oscillators. I'll show you all the charts of these coming up. And we're still extreme negative with the Stochc RSI. Now, we're not seeing that confirmed, at least yet, in the short term with the Williams percent R, the CCI 14, all those. The stochastics are turning more negative, but they're still extreme positive in their readings. Okay, then no change to the overall Fed scenario. They're still kind of in the background where they think the economy's going to get, they're afraid the economy's going to get weaker and inflation's going to go up. And that's kind of the worst of both worlds. And they need more data to try to figure all of this out. So the dollar was down, which, it does end up helping stocks. It kind of sucks if you are an American living in another country and you have to travel to another country to get some currency. I'm talking from a personal story here. And you've seen about a 10 to 15% decline just over the last few months because the dollar's been going down and the exchange rates aren't quite as friendly here. But with the 10-year yield, we're at 4.38%, where we came down from 4.4%. The takeaway from this right now is that interest rates, it'd be nice if they drop down a little bit more, but they're not above that 4.5% level. So that's helping things that way. Sentiment is still neutral. We ticked up one notch, even though we had a down day, but it was options expiration. It's a kind of a crazy day there. We were at 54 after Wednesday. We closed at 55 after Friday. And we're still not trending with the ADX below 20, below the moving average, both in the short and intermediate term. With the slight down day, the bias is negative. I'm still keeping the momentum at mixed because we're looking positive, but we're seeing this weakness drifting in because we're not trending and we're not seeing an awful lot of conviction right now. Okay, so the economic reports that came out, the Philadelphia Fed Index. I don't have the chart for this one. We just go over the numbers here because this is more regional. We still want to talk about it, but I look at other economic reports that apply more to the general U.S. economy. It was at -4. They expected it to be up 0.3. Last time it was unchanged. I do have charts of this one. The leading economic index, it was down 0.1% as expected. Last time it was down 1.4%. So here is the chart of the LEI, the leading economic index or leading economic indicator, where we see the LEI itself. That's the blue line. It's going down, and that's causing some concern. But then you look at the black line, which is the coincident economic index. This is more how things are right now. It's still continuing to go up. So we're seeing a bit of a divergence here. I don't know if you'd call it a positive divergence or negative divergence with the black line going up and the blue line going down. Then this is the one that we look at more for recession purposes. We're dropping more under the red line again. Now, usually when we drop below the red line here, that indicates that we're going to go into a recession. And that could very well happen. Now, back in 2022, we dropped below the red line and went down quite a bit, but we didn't go into a recession at that time. So this doesn't have a perfect track record, but it doesn't mean that this time it's not going to happen. It very well could. That's why we watch the economic reports, especially employment, and try to get an overall feeling for the U.S. economy. And that's kind of being played out here by what we see in this chart. That, yeah, this is going down. Okay, then some real investment advice chart here from Isabel Net blog charts. This is more historical. It talks about the real S&P 500. That means they're taking inflation into account versus conflicts. And this is Robert Shiller. I used his version of his PE ratio, which is the CAPE, CAPE or PE10, because he uses a smooth earnings approach, but he uses historical data. And what was the real price data at that time, and then different events that have happened and so forth. Okay. And then net non-commercial futures, percent open interest over the past 10 years. This fun strat here, and I like this. They make this chart publicly available, but it says for exclusive use of fun strat clients only. I'm not a client, but this is on Isabel Net. Back to contrarian buy levels. So if you go back over time and we go down, get to this red line, that's where, at least according to this chart, it's a good place to come in and buy. But at the same time, I mean, we dropped it. Well, why didn't they mark this area? Why did they mark it here? I mean, they're using hindsight to use, oh, and we were close there. All right. So just because we're here doesn't mean it's not going to go lower. But this is when, at least according to this chart, this is when you start at least looking to buy. All right. Then China's equity market cap concentration ratio is at the low end of its historical range. All right. So yeah, they're having some problems economically in China. And their market, they do have a big stock market. It's not as big as the US, even though there are days when their volume exceeds US volume, but it's kind of down a little bit here. Then this is looking at Friday's options expiration. And you had the 5.9 trillion notional. Now, a lot of this expired worthless, but this is the different options expiration contracts that were getting ready to expire here, and breaking it down. You have, these are contracts just on the S&P 500 itself. Then there's also SPY options, which is the ETF. And this is kind of the crazy one because these are European style options, and they actually, they expire, I believe, on Thursday, but we were closed on Thursday, but then you don't get the price for it until Friday's open. Kind of crazy there. And so, yeah, a lot of maneuvering taking place because of the notional value of some of these options. And so that's why they're kind of hitting some round numbers, and we can see some gyrations on options expiration. Then retail flows have recently been stronger than average. Okay, 3-month, but the 3-month flow is going down here, but we have been going up with all of that. Okay, and then since we did get some housing information, we're a little concerned about this. These are privately owned housing units with building permit issues here. They are issuing building permits, and this has been coming down just a little bit here, not really going up like we were seeing it before. So again, a little bit of the economic weakness that could be drifting into the market. And oil prices, then again, this is more historical, what the price of oil was and how it shot around because of different events that were going on. Then the amount of Fed rate cuts priced by year end, they're coming in, that would be between, well, 46 basis, okay, they do it in 25 basis point cuts. So it basically look at 2 cuts here by the end of the year. That's what, according to the Bloomberg chart, the market is figuring out. But that's down the road. I mean, we're not even halfway through 2025, and they're predicting what they think will happen 6 months from now with a whole lot of variables out there that could totally change things. All right, then looking at this in the euro to US dollar performance according to different time zones, because they trade 24/6, and I believe they close on Saturdays, the foreign exchange markets. Maybe they're open 7 days a week, but I'm not that involved in the Forex market. But it just shows the different performances based on what current market, whether it's New York, London, or Asia, and how those other markets have been doing and where we're seeing the gains and losses when it comes to currencies. All right, then defensive against the S&P, this shows longer term. And this is showing how the staples, energy, healthcare, utilities, those are considered to be the defensive areas that tend to hold up better and maybe advance, but or even go down less when the market is going down. They've really been underperforming a lot here. Now, we watch this more short term to see how things are performing, but you look at a bigger picture of this, and this continues to go down when you compare it to the how the S&P 500 has performed. All right, today marks the start of summer historically. You sure wouldn't know that where I'm at. I'm sitting here with a heavy coat on as I record this. But historically, summer has been the weakest season for equities. It's been good years too, but you look at this over a period of time, and that, people are on vacations, kids are out of school, people are doing things. They're not necessarily as focused on the stock market during that time. And then valuation versus return. This basically just shows what I go over. It seems like I'm a broken record when I do the intermarket analysis video. We're overvalued, but we've been overvalued for years. And that doesn't necessarily mean the market's going to go down. You can't really use this as a timing mechanism. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, here's the intraday chart. Gap higher, got above R1, but that set the high 20 minutes right after the open. Then we came back down, dropped below the daily pivot, dropped down below the unchanged level, tried to find some support here at S1, bounced back up, came back down. Now the unchanged level started acting as a resistance level. Couldn't seem to get back above that. So we dropped lower, down below S1, tried to come up, come back down to S1. See, a real choppy day here. And we ended up closing above S1. And then things are fairly calm as they get set to close for the weekend. They'll resume trading Sunday evening, Eastern time. And still doing okay here, but we're seeing both growth and value intraday for the S&P drifting lower. But we still see the blue line above the red line and drifting off a bit here with the S&P growth to value ratio. But we really haven't come out of this range that we've been in. You can see way over on the left. This is when we were hitting the lows back in April. And then growth had been outperforming value intraday and doing quite well. It just seems to be chopping along sideways for the time being. And then end of day growth was down where value was actually up, and it was down for the mid caps, but down less for the small caps. So we're still coming down a little bit with our end of day chart with the small caps, but we're still above the moving averages. Also still above the moving average with mid cap growth to value, drifting off a little bit, but recently just generated a golden cross here with the S&P growth to value ratio. Still holding up for the most part with this growth to value ratio, and still hanging out around the 200-day moving average when we look at the equal weight discretionary versus staples. That's been one of the weaker areas. And this shows that we're not trending in the short term. The black line, that's the ADX. It's going down. It's below its moving average. Now, we might be getting ready here to see a cross. If the red line crosses above the green line, it hasn't quite done that yet. That would switch our overall focus to negative. But for right now, the green line is just barely above the red line. And they're a little bit closer. You can see a little bit of daylight in between the green and red line here. But the intermediate term ADX continues to decline, and it's below its moving average, and we're not trending. Saw a real volume spike in Friday's session when something big happens. And then when we get up closer to the end of June, we're going to see that again, because that's going to be the end of the quarter. And there's all this window dressing going on, and it can produce a real spike in volume there. But other than that, we're below average with volume pretty much all the time. And now that we're getting more into summer, that's probably going to continue unless something big happens. We are still above 20 with the VIX, both with the line chart and the bar chart. Coming down, at least on an intraday basis here with the VIX of the VIX, but on a closing basis, we ticked up just a little bit. We're above the moving averages as we're seeing just a bit of a pickup in volatility as the VIX goes back above 20. We're seeing the momentum as measured by the MACD, showing how the VIX has been climbing back up as far as momentum. Now, we did get up into this red area. Now, some of this could have been positioning ahead of options expiration, where we come up into this red area, and now we've dropped back down out of it. So the market is still expecting some kind of a big move, but now this signal has actually gone away. I really only show this when we're up in the red area. I wanted to show it again because now we just dropped out of that red area. And a little bit more negative with the individual investors in the latest survey that was taken. They were slightly positive a week ago. Now they've dropped down to being more net negative. And pretty much flat with this fear gauge and flat with this other fear gauge. This is still holding up for the most part. It did decline a bit. This is the risk on to risk off ratio. And we want this to keep going up if we're more positive. And for the most part, it is, even though it was down slightly in Friday's session. And then I reworked this a little bit because I think it was a bit misleading here. When we look at the ratio between U.S. and international stocks, you go back to the beginning of the year and everything was pretty much flat. And then we started coming down here where this means international stocks were really outperforming. Or to put it another way, U.S. stocks were underperforming. And then we hit that bottom in April. And since that time, we've been going more sideways with this ratio. We haven't really been improving, but we haven't been showing a continued deterioration either. And we really spiked up after Wednesday with the daily equity put call ratio chart, and then that really fell down. A lot of that might have had to do with options expiration, but we're still going up with the 5-day chart, which tends to be more negative, and we're still going up with the 10-day chart, which also is a little more negative. It just means there's fear out there and folks are hedging, doing more hedging. And coming down, but still above the range here when we look at volatility risk premium, but still holding up for the most part with the advanced decline line. We're above both the moving averages based on price and volume, and their moving averages are going up. We crossed back above zero with the 10-day advanced decline oscillator, so that's turning a little more positive. We turned up with the short-term advanced decline ratio. That's the blue line, but it's still below zero, turning up and above zero with the more intermediate term advanced decline ratio. Still overall declining with the 5-day moving average of the new highs minus new lows, also declining, but trying to flatten out a bit here with the 10-day moving average. And so, again, we're not seeing a real expansion of the red. That would be new lows. It's more of a contraction of the new highs. We're turning negative here, though. Our smart money indicators are not looking really good right now. We're dropping below the moving average, and that's more negative, and that's bigger picture look, where we have been more negative over the last few trading sessions with the boom indicator as it's been dropping down below its moving average as well. And we're declining with the Chaikin money flow. This is smart money indicator number 2. And we're negative and below the midpoint with the Chaikin oscillator. This is smart money indicator number 3. All three are confirming that things are a little bit more negative now, but we're positive with the vortex. The green line is above the red line. We're seeing a bit of a divergence here. And I know that I say this every time, but I want to make it clear that this is an apples to oranges comparison. This is the S&P 500, which is the bar chart, and then plotting over top of that is the NYSE advanced decline line to try to get a broad market perspective on a more narrowed index here. And we're seeing the red line coming down and actually underperforming the bar chart itself. Yes, they're on different scales, but really more solid times is when the red line is above the bar chart, and more weaker times is when the red line's below the bar chart. So been noticing that over the last few trading sessions. And we were above the green line when we look at the 10-day average of the highs and lows for the S&P. That was showing good longer-term momentum. We're dropping back down now. It's still positive since we're above 50, but the context is that this has been showing some weakness. And we're still above the moving averages with all of the advanced decline line studies. We're right back down to the moving average with the small caps. And declining, but still above zero when we look at a 5-period moving average of the highs minus the lows on the Amex, NASDAQ, and NYSE. This is another attempt to look at the broader market. So it's hanging in there, but the context is that it's been showing some weakness. And we came up with those stocks in the S&P above their 20-period moving average, but we're still below 50. So that's still taken as negative. We ticked up a little bit and we're above 50. So the intermediate term's been holding up a little bit better. It's more the short term that seems to be more vulnerable. And we're above 50 with the 100-period moving average study, but still below 50 with the 200-period moving average study. So here's the daily chart. Looking a bit more vulnerable now. I've been trying to point out as we've been coming up here that even though we haven't been trending, it's been a fairly healthy looking chart where we saw a series of higher highs and higher lows. And then a week and a half ago now, it was a Wednesday, we hit this pivot point here. That's why I have these things on the chart, and they're on here ahead of time, and I update those on the YouTube community tab every day. We hit that, and we've been coming back down since that time, and we're losing that more bullish pattern of higher highs and higher lows. Now it's looking like lower highs and lower lows, at least right now, and we're seeing a little bit more red than green lately, and you can see the spike up in volume, but that's explained by options expiration. And we came back up with the 20-period moving average, but we're still below 50. We're still above 50 with the 50-period moving average, and sideways here, but above 50 with the 200-period moving average. Still extreme negative with the Stochk RSI, and we're declining, but still above the midpoint with the Williams percent R, dropping below the midpoint with the CCI 14, and coming down, but still above the midpoint with the CCI 20. And now we're looking more negative here with the short-term stochastic declining. It's still above the midpoint, but it's been really coming down. We're no longer extreme positive in the intermediate short-term stochastic, but we're still extreme positive with the long short-term stochastic. but it's negative since it's going down below its moving average. And we're actually turning slightly negative with the force index. And this is the short-term trend. And I use some very fast moving averages here, a double and triple exponential moving average. Seeing a little bit more vulnerability. The green line and the blue line are starting to roll over here. When we were really coming up, we were above both of these lines. Then we started to go sideways. That was slowing this down, and now we're actually seeing a little bit more weakness. And I wanted to point out the 20 period simple and exponential moving average. This is why we're still positive, and this is what I use. Some folks use a 21 day, 18 day, 14.263 day, whatever you want to use. But as long as we close above the moving averages, the short-term trend is still considered to be positive. And we're still above the midpoint with the standard deviations chart. We're declining, but still above zero with the balance of power. And this is shorter term, 10 period simple moving average, the green line here. We were coming back down. It was starting to flatten out. And we spent the last couple of days here, 3 trading sessions, actually closing below the green line. But the red line, that's more, I treat it as short term. But the blue line would be somewhat intermediate term, but so far we're holding out above the red line, which is a 20 period exponential moving average. So a little bit of more short-term weakness. Actually turning a little more neutral after being positive with the go, no go, with the lighter blue bars. Still above the midpoint with the highest high value chart. The Landry light is still saying that we're in an uptrend, as is the proper order chart. Looking a little more negative with the TTM squeeze is picking up some of the weakness that we've been seeing here, and we're coming down with the darker shade of blue. This is the rate of change because it's still in here with the lows that were set in April and this massive rate of change chart up here. And just kind of trailing along slightly above zero with the ease of movement. And coming up with the McClellan oscillator, but still below zero. So it's negative. So we're still continuing to decline with the summation index based on price and volume. Tick down a little bit with the NYSE McClellan oscillator and still below zero. So we're declining with the summation index based on price and volume for the summation index for the NYSE. And still positive with the Arun since we're getting an oscillator reading above zero. It had been coming down, but it's leveling off currently. And the swell trading oscillator, below zero and declining based on price and volume, that's negative. Rolling over, still extreme positive with the price momentum oscillator, or PMO, but we're dropping below the moving average, and we're declining based on price and volume. And then the studies that go with that, the PMOs that are rising actually bounced up a little bit. That's showing some slight improvement. The buy signals are trying to level out after declining, but now we're declining a little bit more with the PMOs above zero. We're negative with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR. We turned negative after Tuesday, and we still remain negative now. And we're turning more negative with the slope oscillator. It's still extreme positive, but now it's rolled over and dropping below its moving average. The MACD is negative. So now we're looking more negative with the slope oscillator. We've been seeing a little bit more negativity with the TSI. That's the other short-term oscillator. Then I have 3 intermediate-term oscillators. MACD, PMO, PPO. Those are turning negative, and this is a little bit more of a concern too. The TRIX and KST, they're longer term oscillators, and they're still extreme positive, but now dropping below their moving averages as well. And we're negative with the Kopik curve momentum oscillator, and right on the border between more neutral and positive with the Sean trend meter. Declining but still above 50 with the money flow, but we've dropped below 50 with the ultimate oscillator. Declining but still above the moving average with on-balance volume. This is the condition of the intermediate term trend based on 50 periods. We've spent 5 trading days now below this red line. And it's still kind of going up, but it's starting to slow down a little bit. So for right now, the intermediate term trend is hanging in there. But we hang out below the red line and then eventually work our way down below the blue line. That's going to turn the intermediate term trend more negative as well. But it's hanging in there for right now. We're still above all the plotted moving averages with the 20 periods acting as support. We're declining with the bullish percent index for the S&P, coming down slightly with the NYSE bullish percent index, no longer extreme positive, and now declining with the NASDAQ 100 bullish percent index. And declining, but still above 50 with the RSI 14, and we're just a little bit above 50 with the RSI 9, which is the short term. and we're still hanging out mostly above the rainbow. But now instead of coming down and hitting the 20 period simple moving average of the high, we're now coming down more to the open here. And so we're coming down a little bit more into the rainbow, and it's not been going up as much. It's starting to level off right now. Now, the weekly chart of the S&P, we ended up closing down 0.15% for the week, so we have a red bar here, but we're still looking okay. You look at the series of higher highs and higher lows. Now, we got a little bit of a lower low this last week, but for the most part, the integrity of this longer term upward move is still intact. But if we see more weakness, that's going to break down that integrity, similar to what we're seeing on the daily side. And we're more negative with the Heiken Ashi. We're actually turning negative when it switches over to red with the Kigi chart. That's negative. We're still positive, though, with the Renko chart. We're looking more negative with the three-line break chart. Long term, coming right down slightly above the midpoint here with the 150 moving average study, slightly below the midpoint with the 200 period moving average study. No changes here. Still have mid caps and small caps negative in the long term. All other stocks are still positive. And then we've gone to being positive in the short term with bonds based on price. Commodities are now positive across the board, and that could be inflationary. And the dollar is negative across the board. So we've been seeing crosses above here. We saw a BPI cross below 80 with the tech sector. And then Wednesday it went back above. Now it's going back below. So it's just kind of dancing around right now. The euro's been showing some real strength. Don't I know that on a personal level when compared to the dollar? And then we got above 6,000 with the S&P, but then we ended up falling down below it. With the NASDAQ, first it was above 19.6, then it dropped to 19.5, 19.4. We had the BPI cross above materials, crossing below 80. That had been one of the stronger areas. Industrials also had a BPI cross back below 80, and then communication. Communication is a real growth area where industrials, materials, they're more based on what's happening economically. All right, so then when you see big red ones like this, NVIDIA and Microsoft's actually been doing quite well, but Apple was up to help negate that a little bit. So that's why we're seeing a bit of a mixed picture here. And then we look at Google and Meta, they were both down, so that took communication lower. Amazon was down, Tesla was virtually unchanged. So you see a lot of red in here. And some of the big boxes, those are the red areas, Amazon and so forth, ended up being down. Also seeing a bit of a disconnect here. When we look at the S&P versus the equal weight version of the S&P, the red line's underperforming the bar chart. Now, that could be positive. And a week ago, it looked like the mega caps, the real big stocks, were coming in and taking a leadership role. And they may come back and do that. And that can actually drive the index up. But it's more positive when we see the red line more in tandem with what's happening with the bar chart itself. Still below the 200-day moving average with the Dow, still negative with the Elder's Impulse system for the diamonds, drifting down a little bit now with the NASDAQ. Now we're still above the moving averages. We're not quite there for a golden cross yet, but we're negative after being neutral with the NASDAQ. This is actually a little more positive. This is the NASDAQ 100, the big stocks, and these are also in the S&P 500. We're getting really close to a golden cross. Hasn't quite triggered yet, but we're seeing a little bit more vulnerability here with the overall chart pattern. And we're negative after being neutral with the Qs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is still negative. And small caps. All right, they were virtually unchanged, but they're just kind of floundering around right now. We're still above 50 when we look at the other Russell, the other small cap index, the Russell 2000. We're still above 50 with the RSI, still below the 200-day moving average. The momentum continues to be negative. And we've gone from neutral to negative with the small caps when looking at the Elder's Impulse system, chopping sideways with the mid caps, still negative with the Elder's Impulse system, pretty much going sideways with the Wilshire 5000, but still hanging out above their 200-day moving average, as is the total U.S. stock ETF. Financial sector, it was actually up a little bit. And as I've been saying over and over, the blue line is still above the red line. And this is actually held up better when we were really coming down. Where we've been concerned is when we're doing a ratio between the financial sector and the S&P. We came all the way down to the 200-day moving average with this ratio. And so far, we've been bouncing up off of that. And we'd like that to continue. to see the financial sector come back to actually outperforming the S&P would be more positive. If we drop down below this red line, naturally that's going to be more negative. With FANG index holding up, I mean, we've been range bound lately after generating a recent golden cross, but it's not falling off a cliff, at least yet. So we had Apple up 2.25%, still coming back up to its 50-day moving average, still in a downtrend. Still in a downtrend with Amazon, but it was down 1.33%. Microsoft took a bit of a hit here, but it's really been doing quite well and generating a recent golden cross after they reported earnings. Google dropped down below its 200-day moving average. And then Meta is just generating a recent golden cross and then seeing a bit of a pullback here. Nvidia was down over 1% and above both the moving averages. So we could be getting ready for a golden cross there. Tesla was virtually unchanged, still above its 200-day moving average. Netflix was up 0.75%, and this has maintained a pretty solid upward trend. And we're seeing a bit of an improvement after it's been a weakening when we look at the correlation between U.S. and world stocks, where the longer-term correlation has been getting stronger ever so slowly. It's starting to actually level off now. And this is oil, where according to the chart I use, it was different than what I saw in a different place. They had us in the 73s. This chart had us at 74 currently, and we're in a downtrend with the dollar and continue to be that way. Truflation, latest reading, where we had 2.4%, which was given to us by CPI. They're coming in with inflation at 2.14%, which is an increase. It's been going back up here lately. We're still below 4.5% with the 10-year yield. That's where the red line is here. If we go above that, that's more of a concern. We're still above the 50-day moving average with the 10-year based on price. The momentum continues to be positive, and we're above 50 with the RSI. And looking at our growth to value ratios, coming down, but still above the moving average when we look at the Qs to S&P. Still weak here with discretionary to S&P, coming back down to the moving average when we compare large cap growth to value. Falling below the moving average here with the large caps, coming down but still above the moving average with the mid caps, and coming back down to the moving average with the small caps. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So what's the outlook then for Monday? Haven't changed the overall conclusion here for quite some time. Still positive in the short, intermediate, and long term, but we're not trending. And we're going to get the S&P Global U.S. Manufacturing and Services PMIs. Not major reports, but still something we like to keep an eye on. Existing home sales will be coming out as well. And then, of course, what's going to happen over the weekend? Is there going to be any attacks? Is the U.S. going to get involved? There's still Russia-Ukraine in the background as well. And so people are really paying attention to what's happening geopolitically. And then there's the protests and things going on in the U.S. And then any tariff war news or trade war news that may come out. Here's the economic calendar for the upcoming week. And we have a lot of stuff coming out, but the real big stuff will come out on Thursday. We always get jobless claims each week. We'll get durable goods. Some people don't think that's as important. I like to keep an eye on it. Now, the GDP third reading, this will be the third time we've seen this number. It may be a non-event, but if it comes in a lot different than what we've already seen, that could rattle the markets. The big day is going to be Friday. We're going to get the core PCE, and then consumer sentiment is also going to come out. So here's also a look at the economic calendar for the upcoming week. Seasonality, not a real shift. We tend to be more negative in the week after options expiration. But for June 23rd, we're neutral to negative with the Dow and NASDAQ, where we're neutral to positive with the S&P. And during a post-election year, we do see a few days of weakness here, typically, seasonally. Doesn't mean it's going to happen. It's just what has typically happened before we often during a post-election year see a little bit of a bounce going into the end of June. This is put up by Stock Traders Almanac. This is showing the NASDAQ's 12-day mid-year rally, where some July usually ends up being a pretty good time for that. We'll see if something like that can happen this year as well. All right, we look at our three smart money indicators. They're all negative currently, as is the rate, the moving averages when we look at discretionary to staples ratio. And then the S&P and NYSE McClellan oscillators and summation indexes, they're all declining now. Parabolic SAR is negative, as is the bullish percent index for the S&P. It's further below its moving average. The oscillators are now drifting down for the most part, and the Copic curve is negative. Swollen trading oscillator continues to decline, and the ultimate oscillator has now dropped below 50. And then I'll go over this in the deep dive video that I put out over the weekend. The long-term special K, very long-term oscillator, is still negative, and the momentum for the NASDAQ 100 continues to be negative. Positive side, we did see a recent golden cross with the growth to value ratio for the S&P. It hasn't been doing all that much, but it's above both of the moving averages. And we are declining with the bullish percent indexes for the NASDAQ 100 and NYSE, but they're still positive for the most part. The ease of movement just hanging out slightly above zero. The money flow is still above 50. The vortex continues to be positive, and the financial sector is positive as well. Here are the pivot points, which have already been updated on the YouTube community tab. Feel free to check those out. You can download it and see if this is useful to you. So the conclusion, no changes. If you've watched any of these videos over the last couple of weeks, this is the same conclusion. Positive on all time frames, but not trending. Thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.